Well, welcome. In this video, we're going to be talking about accounting for liabilities. There's essentially two different types of liabilities. There are current liabilities and long-term liabilities. It's important to delineate between current and non-current so that so we know, or the users of the financial statements know, which liabilities are expected to be paid within the current fiscal year and which ones are expected to be paid beyond the current fiscal year, the long-term liabilities. So some of the short-term liabilities would be accounts payable is a common current liability. The invoices you get in the mail every day for buying supplies and materials and all that good stuff. Repairs, maintenance would be accounts payable. That's a typical short-term liability. Current liability, they'll be typically paid within 30 to 60 days for the most part. Depends on discounts and other terms you've negotiated. And then you have payroll, which is a very big current liability. It's current, will definitely be paid within the current fiscal year. If the employees are waiting longer than a year to get paid, then that's a problem. Anyway, so that's a current liability. And then you have others. We're going to be talking about warranty liabilities in this video in a bit. Okay, so we spend some time on that. Long-term liabilities include notes payable. Well, you have short-term notes payable as well. We talk about short-term notes payable. Those are notes payable that are expected to be paid within the current fiscal year. Then a long-term note payable, you take out a loan for a piece of equipment or what have you. A 5-year loan, for instance, you get the first year is going to be current, and then the other 4 years will be long-term. And then you have bonds. Corporations can raise money by selling bonds. They can raise money by selling stocks. They can raise money by selling bonds, or they can borrow money at the bank. There are many avenues to raise money if you're a corporation. So we're talking about that as well. So let's get into it. The first thing we're going to look at is accounting for short-term liabilities, current liabilities. We're going to look at warranties. So let's share my screen with you, and we'll look at that. So if you see on my screen, yes, accounting for warranty liabilities. The key with warranty liabilities is you want to match the expense with the revenue. So you want to make sure that you record the associated projected warranty expenses with the revenue in the year you make the sale. Okay, so you want to do a good job of matching the expense. So you estimate what the warranty liabilities are going to be. So here we have Singer Corporation. They sell sewing machines and they guarantee them for 5 years. Company experience shows that warranty costs about 3% of sales. Singer made sales of totaling $3.5 million during 2021. The cost of machines sold were $1,850,000. For the first quarter ending March 31st, 2022, Singer paid out $50,000 of costs related to satisfying these warranty repairs. So we got a journal provided over here. We're going to record first the sales, which typically they're recorded every day, every week. But here we're going to record them all as though they happen all at once. Okay, for the year, for the full year. So we have accounts receivable. Okay, so we're going to debit accounts receivable for the $3.5 million. Okay, and we're going to credit sales. Okay, to record the sales for 2021. Again, these sales are going to be happening throughout the year. So this is the summation of all the sales you made for the year. Okay, again, you can be journalizing them as they go. But for demonstration purposes, we're going to journalize them right here for the full year. And then we know, because it's a perpetual inventory system, typically, that we have to record the cost of goods sold along with the sales. So we're going to find the account called cost of goods sold. And that is going to be for the cost of the machine sold. And this is $1,850,000. Whether you use LIFO, FIFO, weighted average cost, we don't know. But for this problem, we don't care because we know the cost of goods sold is $1,850,000. And we know merchandise inventory is leaving the building. So we're going to credit what is leaving the building, merchandise inventory. So we have sales of $3.5 million, cost of goods sold of $1,850,000. So you can see how much we made between 3.5 sale price and $1,850,000 of cost. Okay, so that's the entry to record all the sales for the year for 2021. Now, because we are good accountants, we want to make sure we record the associated warranty expense in the year of the sale. What is the warranty expense? Well, it's estimated to be 3% of sales. So we want to make sure we set aside 3% of our sales and put it into the bucket called estimated warranty liabilities. So we're going to debit the expense called warranty expense. Let's find it here. Warranty expense for 3% of our sales. So it's going to be $3.5 million times 0.03 or $105,000 debited to warranty expense. And we're going to put the money in the liability, the accrual account, estimated warranty liability, $105,000. So as warranties happen, we're going to pay them out of the accrual, the liability we have set up. So what happens at the end of the first quarter of 2022, Singer paid out $50,000 of costs related to satisfying warranty repairs. Let's just assume it's all cash out the door. So what happens? We're going to debit or take some money out of this liability account. So we're going to debit the estimated warranty liability for the amount of liability warranties we satisfied, and we're going to credit cash to pay. Cash was paid out for these warranty repairs or what have you. Okay, so that's how you account for warranties. Some of the key, again, the key things, you want to match the expense with the revenue for the period. We had $3.5 million of revenue, and we estimate 3% of the revenue is going to be expense over time. So we put money in this bucket, and we use this to satisfy warranties as they happen. Okay, so was the ending warranty liability account at the end of March 31st, 2022. If the beginning balance was $75,000, it's just some fun with numbers here. So if we had $75,000 before we made our $105,000 entry, we added the $105,000 to the bucket. I call it a bucket, right? So once we put the money in there, and then we used up $50,000 at the end of March. So we should have sitting in our general ledger in our estimated warranty liability account, $130,000. Again, the $75,000 we started with before we made this adjusting entry for the year. So we added $105,000 to the 75. We took away 50 at the end of March. So at the end of March 2022, our balance should be $130,000 on the books. Okay, so that's how you account for warranties. All right. The next thing we're going to talk about, another current liability, which is near and dear to everybody, if you have a job and you get a paycheck, is payroll. So payroll, we have a demonstration here we're going to go through. Before we do that, there's a couple, just one thing I want to talk about payroll is Social Security or FICA. FICA is comprised of two parts. You have the Social Security piece, Social Security piece and the Medicare piece. The Social Security piece is 6.2% of annual wages up to, for 2023, is $160,200. That means as an employee earns $160,200, once they hit that buzzer, if you will, that cap, the Social Security, they stop contributing to the Social Security system. Okay. Medicare, however, is 1.45% of wages. There's no annual limit. Plus, is a 0.9, almost another percentage for annual wages above $250,000 for married and $200,000 for single for the year 2023. Okay, so for Social Security, the most anyone can contribute to Social Security is $9,932 for the year, which is 6.2% of the annual wage limit. So I have some example of three people here. You have a baseball player makes $25 million. What are they going to pay into Social Security? They're going to pay the max, right? The $162,000 times a 6.2%, or they're going to pay $9,932 into the Social Security system. So let's look at the store manager. What's the store manager going to pay? Well, he's making $175,000 and the cap is $160,000, $200,000. He's going to pay the same thing that the baseball player is paying into the Social Security system. $162,000 times 6.2%. or $9,932. They're both contributing the same amount. The baseball player earning $25 million and the store manager earning $175,000 are contributing the same amount of money into the Social Security system. If you think about the Social Security system, it was set up by FDR way back during the Great Depression to help as an insurance blanket, if you will, to make sure that employees are saving money for their future. So think of it as a government-sponsored 401k. Okay, that's basically what it is. So what you put in is what you get out, hopefully, unless if they don't have money in the account. But anyway, there should be money in there. There's a lot of talk about the Social Security system drying up and out in the future, maybe whatever. I forget how many years out from now, but there'll be money there. They'll find a way to make sure there's money there. So anyway, I hope. And then your factory worker making $80,000. Well, he hasn't hit the buzzer, so the 80,000 times, oops. Try that again. The 80,000 times 6.2% is going to be $4,960 for the year. That's the total contribution for the year. And these are, again, it's the annual contribution, annual amounts. Okay. So then for Medicare, that's the other piece. Okay. It's at 1.45% of wages. So what is the baseball player who's making 25 million contributing to this? Well, he's contributing the 2.5, it's $25 million times 0.0145%, 0.0145, 1.45%, plus the wages of 25 million minus, let's assume he's married, filing joint, $250,000 times 0.9%. So he's going to pay into the system $585,250 into the system. The store manager is just going to pay, because he's not over the 250,000. Let's assume he's married or she's married, what have you. Okay, let's assume the store manager is married. So then what they're going to pay is the 175,000, and there's no cap, times 1.45%, or $2,538. And then the factory worker making 80,000 a year would pay in 80,000 times 1.45%. So you see, the store manager and the factory worker are just paying up to 1.45% on their total wages, because they're not over the annual wage limits before you start paying additional Medicare. Well, a baseball player is making well over $250,000, so they're paying not only the 1.45% on the 25 million, they're paying the excess of the 25 million over the $250,000 if they're married filing joint, or 200,000 single. So you can see into the system, the baseball player is paying almost $600,000 to the Social Security Administration, with the store managers $12,470, and the factory workers just over $6,000. Okay, so you can see how Social Security is a little complicated, and it has two tiers. One other thing about Social Security is that it's a matching contribution. The employer will match whatever they take out of your check. Okay, so going back to this payroll example, let's look at it. Okay, so we have the Rogers Corporation has 2 employees. Each employee is paid overtime at time and 1/2 after the first 40 hours worked for the week, which is pretty typical. After 40 hours, you get time and 1/2. The current Social Security and Medicare taxes are 6.25% and 1.45% respectively. Social Security is capped at, change that to $160,200 of annual wages. The current unemployment tax rates are 5% for state and 1% for federal on the first $8,000 of annual wages. We'll talk about that in a bit. Below is payroll information for the first week of the new year. Therefore, the annual wage caps will not apply, because no one's going to be hitting those wage caps in the first year, the $160,000 for Social Security, or the $8,000 for the Social Security for the unemployment taxes. So let's talk about unemployment taxes. Unemployment taxes are paid by the employer. So the employer has to account for that. They're not going to deduct it from your pay. You don't ever see unemployment taxes taken out of your check. That is just the cost of the employer. And that is based upon a couple of things. The employer's experience, how many times they're hiring and firing and sending people to the unemployment lines. They're going to drive up their rate. It's also going to drive up their base wages that they're paying out, because typically they're paid out on the first $8,000 of wages. Or if it's Massachusetts, it's $15,000. Every state's a little different. So the first $8,000 of wages will be paid out in terms of the 5% state and 1% federal. So if you let's use a hypothetical example. Let's say that you made $32,000. It's $8,000 every quarter. Let's say after the first quarter you went to work for somebody else. Well, the company you're currently working for has already paid into the Social Security, the unemployment agency, the 5% for state and 1% for federal on your 8,000. But once you go to the new place of hire, that company that hires you has to pay 5% for state and 1% for federal on your first 8,000 again, even though it was already satisfied by your previous employer. That doesn't matter. Okay. So then if you can conceivably, let's say you had 4 jobs for the year, every company you go to is going to start day one up until $8,000 paying into the Social Security, the unemployment agency, the 5% for state and 1% for federal. Okay, so let's look at an example. I simplify this to keep it, make sure you understand the concept. It's just the first week of the year. So again, no annual wage caps will apply. Just try to keep it simple so you understand the mechanics. So here we have 2 employees for the Rogers Corporation, Devante and Aaron. Okay, Devante earns $35 an hour. Aaron earns $32 an hour. You can tell I was playing fantasy football when I put this together. Okay, so Devante worked 52 hours and Aaron worked 48 hours. So you can see Devante worked 12 hours of overtime and 12 hours over 40, and Aaron worked 8 hours of overtime. The current federal withholding rate that they pay Uncle Sam is 20%. There's no state income tax here because they work in a state that doesn't deduct for income taxes, or they don't have to pay income taxes for the state. So we can ignore that. The 401k, Roth 401k deduction, again, it's after tax, just to keep it simple. And it's also something that I recommend, but that's beyond the scope of this course. Again, Roth 401k is the way to go, in my opinion. Okay, then health insurance, we're going to can treat this as after tax, even though usually it's typically pre-tax, but to keep it simple, we treat it as after tax. And savings at the credit union, this is money that they're saving, they're putting money aside to save in their credit union. Okay, so let's take a look. Let's complete the step 1 is to complete the payroll register, okay, for the week. And typically, if you have an outside payroll service like ADP or Paychex or Paycom or Paylocity, there's a bunch of them out there. You'll get this payroll register sent back to you once you submit your payroll. But we're going to do it together here. So let's do regular wages. What is Devante's regular wages? Well, it's going to be the 40 hours a week times his rate of $35 an hour. So his regular wages are $1,400. The overtime wages are going to be the 12 hours of overtime, right? 52 minus 40 is 12, times his rate of $35 an hour, times 1.5. So he's going to make $630 of overtime. So his total gross wages will be the $1,400 of regular plus the $630 of overtime. He made $2,030. Let's see, look at Aaron. Aaron, 40 hours times $32 an hour, $1,280. Overtime, he worked 8 hours of overtime, right? 48 minus 40 is 8, times his $32 an hour, times time and a half, 1.5. So his overtime is $384. Add it up, you get his total gross pay. Okay? Gross pay means before taxes. It's not like, oh, this is gross. Somebody might feel like this is gross, whatever. But your gross pay just means before taxes. So we can add those up and you get total payroll so far for these 2 employees for the week. These are all the employees that Rogers has in this corporation, are these 2 employees. So then we have federal withholding taxes, which is 20% of the gross pay. So Devante, 2030, gross pay times 20% is $406. And then Aaron, he's got 1664 times 20%, or 332.80. Total it up to, while we're at it, okay, $738.80 of federal withholding. Now we have Social Security. Social Security is going to be based upon 6.2% for Social Security, and Medicare is 1.45%. So we're going to take our Social Security, it's going to be 2030 gross wages times 0.062. Okay. The problem is that if I added a decimal here, it's going to come out. Well, that's the case. That's fine. Sometimes when you add the decimals, it doesn't come out. I'll show you in a second. So let's take the gross wages of 1664 times 0.062. And if I add the decimal here, you'll see it's 103.168. Payroll doesn't happen like that. It's not 103.168. So it's actually rounded to 103.17. Okay. All right. You can make it back to 2 decimals. So we can add those up. Total Social Security tax, then Medicare, same thing. Your total gross pay times 0.0145. Whoops. What did I do? Total gross pay times 0.0145. And it's 2944, just to make sure there's not an extra decimal in there, which there is. So we want to make sure we round it to 2944. And the same thing with the Aaron Jones. So you take 1664 times 0.0145, that's 2413. So you have, again, you want to make sure you round that to 2413. It's 24.128. Payroll is in pennies. There's not in 3 decimals out. They're in down to the nearest penny. Okay. All right. So total Medicare tax. Boom. Okay. Now Roth, the Roth 401k. That's pretty straightforward. Devontae has $150 taken out of his check, and Aaron has $200 taken out of his check. Health insurance. Devontae's paying $200, and so isn't Aaron. And then credit union, $200 out of Devontae's check and $150 out of Aaron's check. Okay, we'll total these up. Boom. So total deductions, total withholdings for Devontae, we add them all up. We got federal withholding plus the Social Security plus Medicare plus Roth 401k plus health insurance plus the credit union is $1,111.30. We can copy this formula down. Okay, it's 101010, very binary. 101010 for Aaron Jones. Okay, add it up. Okay, and then the net pay. The net pay or the take-home pay is simply going to be the gross pay minus the deductions or withholdings. So Devontae goes home with $918.70, and Aaron goes home with $653.90, and the net for total take-home pay is $1,572.60. So once we have this payroll register, we're going to create the journal entries. Every payroll has 2 journal entries. 1, to record all the pay stubs of all the employees or the payroll register, and 2, to record the payroll tax expense. Okay, so let's look at the pay. Let's journalize this payroll register here as the first entry to record the payroll entry for week ending January 7th. So we're going to debit the wages expense for the gross pay. So we find wages expense somewhere here, wages expense, and that's going to be for the $3,694. Okay. Now we're going to credit all the withholdings. Federal withholdings, Social Security, Medicare, Roth, Health, Credit Union. Okay, so we're going to find each one of those. Federal withholding. Let's find it. Federal withholding right here. So that's $738.80. Okay. Then we have the Social Security withholding payable, Social Security tax payable. That's going to be the $229.03. And then we have Medicare tax payable. Okay. And oftentimes these 2 accounts are usually lumped together as FICA tax payable in people's accounts, but I'm keeping it separate for illustration purposes. Okay. And then you have the Roth 401k, the amount that's going to go into the back to whatever Fidelity, American Funds, whatever the company's using for their 401k. And then we have the health insurance payable, the amount that's going to be deducted from their contribution to the health insurance that's going to be paid out to who's ever carrying the insurance. And then we have the credit union payable, the amount we're withholding for the employees and submitting it on their behalf to the credit union. Okay, so money is going to be direct deposited perhaps into their credit union account. And then we have to credit wages payable for the amount of the take-home pay. This is the amount that needs to be in the checking account to satisfy all the checks as they clear, 2 checks as they clear. 1 check for $918.70 and 1 for $653.90. Checks or direct deposit. Typically it's direct deposit. Okay, so that's the entry. All this we've just journalized the bottom of all these categories, right? These accounts into our first payroll entry. Now we have the payroll tax expense, which is comprised of, well, let's find a payroll tax expense account. So we're going to find that somewhere here, payroll tax expense. This can be comprised of 4 accounts. We have FICA, which is Social Security and Medicare, and we have federal and state unemployment taxes. Okay, well, let's do the easy one first. Let's do the Social Security and Social Security and Medicare. We know the Social Security is a matching tax, so the corporation is going to match, or the company is going to match whatever they take out of the employee's check. The employer is going to match it. So they're going to send the $229 plus $229, total $458 is sending to the Social Security Administration. And also the Medicare, same thing. They're going to match the Medicare. So whatever they take out of the employee's check, they're going to match that. Okay. Then you have the 2 unemployment taxes, federal and state unemployment tax. So let's do the state one first. All right. The state is going to be, as I said, 5% for state and 1% federal. So because none of the employees have hit the $8,000 limit yet, we can simply take the gross wages, the $36.94 times 0.05. You get $184.70. And then the federal unemployment tax is going to be, let's find it, where is it? Federal unemployment is going to be, for this illustration, it's $36.94 times 0.01, or $36.94. So the total payroll tax expense is going to be the summation of these 4 accounts, which is going to be $504.24. Okay, so that's how you account for payroll. Okay, again, every payroll has 2 entries. Record all the pay stubs of all the employees and also record the payroll tax expense. You notice there's no unemployment taxes on the pay stubs of all the employees in the payroll register. It's only on the payroll tax expense. And the Social Security and Medicare are matching payables, right? Matching expense. So they're going to match whatever they take out of the employee's check. Okay, so that's how you account for payroll. Okay, now let's talk about bonds. Okay, bonds payable. But it's another way for corporations to raise money. They can sell bonds. They can sell stocks. They can sell bonds. So bonds are you can get really in depth with bonds, but we're gonna just touch the surface on these, and we'll cover them as best we can without getting too deep for this fundamental accounting course. So Jackson Company sold $250,000 worth of bonds to raise money for a new warehouse. The bonds pay interest at 3% for 10 years. The market rate of interest for a similar instrument was 3.5%. Therefore, the bonds sold for a discount. So when the bonds pay something less than market, they're going to sell for a discount. If the bonds were paying 4% and the market was only 3.5% for a similar instrument, they would pay at a premium. They would sell for a premium. If the bonds in the market were the same, then they would just sell at par value, the $250,000. But because someone can go get another bond for 3.5%, they're only going to pay $239,604. And I'll show you how that calculation works. It's not. It makes sense intuitively because you're not going to pay full price or something. The law of supply and demand says you wouldn't pay full price for that if you can get a 3.5% bond someplace else, right? But it's all based upon the math, using the present value of a bond, we take the present value of the payment streams. So we have the present value of the principal, which is $250,000. The interest rate is the market rate of interest, and these bonds pay interest on an annual basis. So it's 3.5%. Oops. Okay, and the term is 10 years. So the present value of $250,000 that we have to wait 10 years to get is worth $177,230 because of the time value of money, okay, based upon a 3.5% discount rate or 3.5% interest rate, the market rate. You always use the market rate when you present value these instruments. Then you have the present value of the ordinary annuity, which is the interest payment. So the bonds pay $250,000 times 0.03. They pay $7,500 a year annually. Sometimes bonds pay semi-annually, sometimes annually. Okay, so again, we use the 3.5% rate for a period of 10 years. The present value of the interest over the 10 years, again, present value, what's it worth today, is $62,375. So that's where the 239,604 comes from. Just for fun, let's say that the market rate was 3% and the bonds are paying 3%. If I put 3% in here, lo and behold, the bonds would sell at par value or face value, $250,000. If the market rate was only 2.5%, then the bonds would sell at a premium, $260,000 versus the $250,000. But we know in this case, the bonds were selling or paying interest at a rate lower than the market, so therefore they sold at a discount. So let's record the bonds. When we sold the bonds, the corporation got cash, not $250,000. They only got $239,604. Okay, and then they have something called a discount on bonds payable. The discount on bonds payable is the difference between the $250,000 less the amount of cash that they received. So they have a discount of $10,393. Oops, did I do that right? Oh, I did it wrong, sorry. So I put a 7 in there instead of a 4. Okay, $10,396. And then the bonds payable always go on the books at their face value, our value, $250,000. Okay, so here's the entry. We put the cash, the corporation received the $239,604. The bonds went on the books at $250. And the discount on bonds payable, the $10,396, goes on the book as a contra liability account. Why is it contra? It has an opposite balance. Okay, so the carrying value of these bonds, the difference between the bonds payable minus the discount on bonds payable, or $239,604 day one. Okay, so then this discount on bonds payable will turn into interest expense over time. Okay, so Part B says record the first interest payment and the amortization of the bond discount. We're going to use a straight line method. Okay, so we're going to record the interest to the nearest dollar, and the company uses a straight line. So what happens? So we have, well, the interest expense is going to be debited, but we'll get into that. We'll save that for the last we record here. Let's find interest expense. But cash is going out the door. How much cash is leaving the building? Well, it's $7,500 is what we're paying. These bonds pay $7,500. And the discount on bonds payable has to be amortized over the life of the bond. Well, it's 10 years, so every year is going to be $1,039.60. We're going to round it to the nearest dollar. So we're going to have the discount on bonds payable is going down by $10.40. Okay, so the interest expense is going to be the cash that was paid out plus the amortization of the bond discount. So the interest expense is higher than the cash paid out. Why is that? Because this, again, as I said before, this, as you amortize this discount on bonds payable, it turns into interest expense. That's why your interest expense is always going to be higher than your cash when you amortize a discount on bonds payable. The opposite would be true if it was a premium. It would decrease your interest expense because you were amortizing a premium instead of a discount. Okay, so what is the carrying value of the bonds after the first year? Okay, well, it's going to be the $250,000 of the face value of the bonds minus the 10,396, which is the discount, but plus the 1040, the amount that we just amortized. So our carrying value is going to be 240,644. Again, it's the cost, the face value of the bonds minus what is remaining in the discount on bonds payable account. As I showed you before, the face value is 250. We initially had the discount of 10,396, but we just amortized 1040 of it. So we basically reduced discount down by 1040, 10% or 1 year. Okay, so then our carrying value on the bonds is going to be 240,644. Okay, so every year there'll be an entry similar to this as the bond amortizes. Okay, and gets paid out over 10 years. Okay, so that's how you account for bonds payable. All right, let's talk about notes payable. There's short-term notes and long-term notes. Short-term notes are those notes that will be paid within the current fiscal year. So let's look at that. Accounting for short-term notes payable. Jackson Company borrowed $50,000 from the bank on June 12th, 2023. They agreed to pay the bank. Sorry. The principal of $50,000 and 6% interest in 60 days. Okay, so Jackson is the maker of this promise. There is a promissory note with the bank for 60 days. They're going to pay the amount they borrowed plus 6% interest for 60 days. So let's record the borrowing on June 12th. So on June 12th, what happens? We have the borrowing. So what do we borrow? Well, we get cash coming in. We borrowed $50,000. And we have a note on the books, which is a short-term note payable for $50,000. Okay, so there is the note on the books. Okay, cash debited and the note payable credited. Okay, short-term note payable. So now let's record the payment 60 days later. Well, what is the 60 days later? What's the due date of this note? Well, because we know Excel is pretty cool and that it has a number behind every date, we can simply take the date plus 60, and that is the date of the note being due 60 days later. Okay, as I can go back here and format the cell into a number, you can see that. So June 12th is day 45,089, and August 11th is day number 60 days later, 45,149. Behind every date in Excel is a number, just so you know that, in case you didn't know. So that helps us determine, in this case, that the due date of the note is August 11th. So what happens on August 11th? We're going to pay back the loan to the bank. So what happens? The short-term note payable comes off the books. So we have a short-term note payable coming off the books for $50,000. And it goes on the books at $50,000, comes off the books at $50,000. We have the interest expense. We're going to calculate or pay the interest expense. And how much is the interest expense? Well, it's principal times the rate times the time. Well, the principal is $50,000. The rate is 6%. And the time is going to be 60 divided by 360. There's 365 days in the year, but we use 360 for calculations to keep it simple. Okay, so 50,000 times 0.06, 6%, times 60 divided by 360. There's $500 of interest associated with this. So we're going to pay the bank $50,500 to pay off this short-term note payable. Okay, so we borrowed the money for 60 days and we kept our promise and paid the bank back the principal plus the interest, $50,500. Okay, that's what counts for a short-term note payable. Let's take a look at the long-term note payable. Stevenson purchased a new machine for $850,000 on January 1st, 2021. They obtained a loan at the bank to finance the purchase. The terms of the loan were 7 years, 4% interest, annual payments of principal and interest on December 31st. I used annual payments. That doesn't happen in real life, but to keep it simple, typically banks want to be paid monthly, but to keep this illustration simple, I used annual payments. So over here is a table And you can find an amortization table in Excel. They're available as a free template in Excel. When you log on Excel, just click on free, open. You have loan amortization schedule, whatever, at your fingertips. Okay, so I just created this myself. The loan amount is $850,000. That's what they borrowed. The annual interest rate is 4%. The annual payments, the number of payments is 7 payments. So the annual payment is going to be $141,618. $141,618 is the annual payment. You see here, it created a nice little table. Year one, we're going to pay $107,618 of principal and $34,000 of interest, and there's our ending balance. You see, over time, as we pay down our principal, our interest expense is going down. And the principal amount of this $141,618, the amount we pay towards principal increases, and the amount we pay towards interest decreases over time. Okay, you'll see that if you have a mortgage or what have you. Okay, so then every line item is a journal entry. Journal entry for year 1, 2, year 2, year 3, etc. So we can journalize this. So first of all, let's record the purchase of the new machine on January 1st of 2021. So we have the machine, let's find it, equipment, $850,000. And we put the note payable on the books, loan payable, note payable, $850,000. So there's the note going on the books, the amount we owe the bank. And then what's the first payment? Well, we paid $141,618, of which 107 was principal and 34 was interest. So we can record that here. We have the interest expense. Let's find that interest expense. That's going to be the $34,000 right from this table. And then the principal we paid back of this note payable. So note payable is going down by the amount of 107,618. And then cash is flying out the door at the 141,618, the annual payment that was calculated from this amortization table using this payment calculation here. Okay, so then year 2, same entry, different numbers, right? We have who's going to journalize year 2 here, so we can copy these accounts down. And the interest expense is going to be $29,695. See how it's gone down from $34,000 previous year to only $29,695 the second year. The note payable is going to be $111,923. Whoops, $111,923. And the cash flying out the door will still be the $141,618. So that's how you would journalize this. Every year there'd be an entry until you get to year 7, until the note is finally all paid off. Okay, and what's classified on the balance sheet, the current year would be listed as a current liability, and the other 7 years would be listed as, this would be long-term, this would be current, this would be long-term on your balance sheet, okay, for year 1. And as you year 2, then your long-term liability is only years 3 through 7, etc., etc. Okay, so what's the loan balance at the end of December 31st, 2022, which is the second year in? Well, it's the $630,459. It's already calculated for you on this schedule, right? That's the amount that we owed after 2 years. We initially owed $850,000, but we paid $107,618 and $111,923 towards it. So now our balance is only $630,459 after December 31st, 2022. Okay, so that's how you account for notes payable. And I hope you'd enjoy this. I hope you learned something about liabilities. And I'll see you next time. Okay.